All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be talking about ticker AMZN, Amazon. Just give me one moment to double check the stream settings and make sure everything is up and running before we get started. Okay, make sure thumbnail's correct this time. We had that problem last time. Okay, everything looks good. So this one should be a pretty fun one. As I said with Facebook when we covered that one, that prior to doing all these valuations in this particular quarter with all the 10Ks coming out, if I had been asked based off of my previous valuations to choose a couple of the US mega cap tech stocks or whatever, FANG stocks, FANG plus, whichever way you want to call them, I would have said that Facebook and Amazon were the two best deals of the bunch. Google and Tesla kind of being the worst deals, generally speaking. Or well, maybe it was Tesla and Netflix that were the worst deals. Google might have been a little bit better than that, but either way. So I'm curious to see where Amazon's valuation is today, especially with the more recent volatility in the price action, as well as just the general growth of it. Looking at Amazon on just kind of like a lot of the usual basis of things that I like to pay attention to, the qualitative factors that I talk about, the adjusted net margin after adjusting for R&D, as well as sales to capital ratio. They have a pretty decent sales to capital ratio in the year 2021 because I did do the most recent year already, as I typically do, and that makes their company look pretty strong relative to a lot of other retailers, because retailers tend to have low margins with high sales capital ratio, so they have a pretty good sales capital ratio with a decent net margin. Granted, this does not have the amortization effect put through on it. So just kind of talking about one of the reasons why Amazon generally stands out as a good buy, in my opinion, relative to the other ones for those particular reasons. And Facebook is pretty strong on those reasons, though, as we saw, Facebook has a much lower sales to capital ratio, though they have higher margins. So I'm curious to see how that comes out today. But looking at our watch list, however, briefly, you can see a lot of the top stuff hasn't shifted too much. Facebook is pretty highly listed as of now. It's moved a little bit higher than it was previously on our list. I have adjusted a few little details in the valuation. I typically do that a little bit here and there after the streams. It's not usually major changes, but sometimes I make small adjustments in the day or two after. Sometimes there's comments that come in that give me ideas for something. But on the lower end of things, as I was talking about, I am slowly but surely selling out of Royal Dutch Shell. It is really far down the list at this point. And Tyson, like I said, I've kind of been trying to lower my my exposure to them because it's just a really large position, but I'm not doing so at a very fast pace because they do have relatively low returns, but it's not absolutely terrible. And I do like that exposure regardless, but it is starting to be trimmed down. Looking at our kind of list of companies, like I said, that we're looking at, obviously we're doing Amazon today. I do plan to do a stream tomorrow, and I'm probably going to be covering Tesla, and that will complete all of the mega cap stocks that I've been talking about. So I'm going to be pretty happy to have gotten all those ones done. And then at that point, we'll be moving on to some of the others in this list, as well as other ones in my portfolio as they come out. So I'm uncertain about what exactly the order will be after that, but we're definitely going to be doing Tesla tomorrow, and then I'm not sure on Monday. And then as I said on Monday's stream, we'd be talking about some of the economic stuff that has happened over the week. We did talk about the international trade in goods details. I'm not really going to talk too much about the wholesale inventories. I'm not very interested in that on the whole, but I pay attention mostly to the business inventories as a whole with the retail sales and sales to inventory ratios. But we will be talking about the CPI near the end of the stream pretty significantly. There's a lot of stuff to talk about there, as well as I'm going to kind of share some of my thoughts on gold and how that relates to inflation a little bit, but we'll get into that near the end of the stream. Yeah, hey GT, welcome. Good making it on time. So anyway, we'll get into Amazon, as I was already kind of talking about some of the qualitative factors that I like about the business. I'll talk about some of the prep work I already did on it, having separated their segmentation based off of the different types of business they have: online stores, physical stores, third-party seller services, subscription services, advertising services, AWS, and other. It's a pretty nice way for them to disaggregate their revenues. I really like that. Actually, it's really specific and easy to like segment out. It's not as quite as scattershot as some of these other companies that I do with many segments. But either way, it gets us an unlevered beta of 1.41. They don't have a crazy amount of leverage, but they do have more leverage than some of the other Fang Plus companies. I think it's probably in a pretty appropriate range. I think theirs is like around 10% or something. 10 to 15% is probably appropriate for them. 2.34 is expected for the sales to capital ratio, with 9.72 for the net margin. So like I said, they have a lower than that sales to capital ratio, but it's still pretty good. And they have significantly higher margins than that. So it is pretty good on that basis as well. 67 or so percent of the revenue is coming from the United States, with 7% coming from UK, 8% Germany, 5% Japan, and 13 to 14% from everywhere else. I do find it interesting the disproportionate amount of their business assets, both in the international segment as well as the AWS assets, that are outside North America relative to the North American revenues. It's very interesting, but not super important. And then, like I said, $132.6 billion in debt, 12 years average weighted maturity with 2.3% interest rate. So very good interest rate to have on the debt and a pretty decent maturity profile. And the $132.6 billion sounds like a lot, but obviously relative to $1.6 trillion, it's not at all. It's less than 10% actually, is what it looks like. Probably more like 7 or 8%. So they could probably double their debt, the debt to equity ratio, without it being an actually dangerous ratio. So anyway, that's pretty much all the prep work that we've done ahead of time. As usual, I will play the fourth quarter earnings call as I work. As you can see, I assume GT's already liked the stream. Thank you very much. Anybody else that pops in or watching on other platforms, if you could like, subscribe, share, it would be very much appreciated. We're definitely trying to grow this channel as much as we can, aiming for 100 subs or so in the near future.
Thank you for standing by. Good day, everyone, and welcome to the Amazon.com Q4 2021 Financial Results Teleconference. At this time, all participants are in a listen-only mode. After the presentation, we will conduct a question-and-answer session. Today's call is being recorded. For opening remarks, I will be turning the call over to the Director of Investor Relations, Dave Files. Please go ahead.
Hello, and welcome to our Q4 2021 Financial Results Conference Call. Joining us today to answer your questions is Brian Olsavsky, our CFO. As you listen to today's conference call, we encourage you to have our press release in front of you, which includes our financial results as well as metrics and commentary on the quarter. Please note, unless otherwise stated, all comparisons in this call will be against our results for the comparable period of 2020. Our comments and responses to your questions reflect management's views as of today, February 3rd, 2022 only, and will include forward-looking statements. Actual results may differ materially. Additional information about factors that could potentially impact our financial results is included in today's press release and our filings with the SEC.
Huge growth in non-operating income in 2021. That's interesting.
Filings. During this call, we may discuss certain non-GAAP financial measures. In our press release, slides accompanying this webcast, and our filings with the SEC, each of which is posted on our IR website, you will find additional disclosures regarding these non-GAAP measures, including reconciliations of these measures with comparable GAAP measures. Our guidance incorporates the order trends that we've seen to date and what we believe today to be appropriate assumptions. Our results are inherently unpredictable and may be materially affected by many factors, including uncertainty regarding the impacts of the COVID-19 pandemic, fluctuations in foreign exchange rates, changes in global economic conditions and customer demand and spending, inflation, labor market and global supply chain constraints, world events, the rate of growth of the internet, online commerce and cloud services, and the various factors detailed in our filings with the SEC. This guidance also reflects our estimates to date regarding the impacts of the COVID-19 pandemic on our operations, including those discussed in our filings with the SEC. Our guidance also assumes, among other things,
You'll see their free cash flow to equity was negative in 2021. They did promise to be returning to growth, and their cash flow seemed to be showing that.
And
so
therefore, our actual results could differ materially from our guidance. And now,
and that's with taking debt on too. So
today. Let me start by once again acknowledging and thanking our employees around the world for their efforts. This was the second holiday season during this pandemic, and it required exceptional collaboration and coordination among our employees and business partners to prioritize both safety and customer experience. The team did a great job at delivering for customers this holiday. Now let's discuss our fourth quarter financial results. For the fourth quarter, net sales were $137.4 billion, an increase of 10% year over year, excluding the impact of foreign exchange. We continue to focus on offering the best experience for our customers across our businesses. On the consumer side, we welcome millions of new Prime members in both the United States and international during the quarter, while continuing to see consistently high member renewal rates across geographies. Our third-party sellers in particular benefited from strong customer demand this holiday season. 3P sellers provided 56% of all unit sales in the quarter, the highest fourth quarter mix ever. And AWS saw continuation of the strong usage and revenue growth we've seen throughout 2021. AWS added more revenue year over year than any quarter in its history.
yeah, I think it was like a 40%
$51 billion annualized run rate
increase for AWS.
$51 billion.
We'll look at their earnings deck when we do projections.
Even on a large base, revenue increased 40% year over year.
Yeah, there it
As
is.
I've mentioned in prior calls, we also encourage you to look at the multi-year compounded annual revenue growth rate since the onset of the pandemic to better put this revenue growth in perspective. Despite lapping 2020's extraordinary sales growth, we continue to see an increase in customer demand and sales during the remainder of 2021, even as the economy opened back up. For Q4, Amazon's two-year annual compounded growth rate was 25%, excluding impacts from foreign exchange, consistent with our rate in the third quarter. We've invested significantly to keep pace with this demand, including nearly doubling our operations capacity in the past 2 years.
I did bring up the disproportionate amount of assets they have international relative to U.S. revenues. I do think that's part of the reason they have the interesting FX
Amazon employees worldwide, also doubling in the 2-year period.
movements on the revenue.
Income was $3.5 billion. As we mentioned in the last earnings call, we did see more than $4 billion in costs from inflationary pressures and lost productivity and disruption in our operations. The inflation primarily relates to wage increases and incentives in our operations, as well as higher pricing from third-party carriers supporting our fulfillment network. Lost productivity and network disruptions were driven primarily by labor capacity constraints due to challenges in staffing up our facilities for peak. This was driven by the very tight labor market in the second half of 2021, and more recently by the emergence of the Omicron variant. We do expect these cost challenges to persist into Q1, albeit adjusted for lower seasonal volumes relative to the fourth quarter. Our results also include approximately $1 billion year-over-year negative impact from lower fixed cost leverage in our fulfillment network. Recall that we saw very high unit volumes for most of 2020 and the first half of 2021, and our fulfillment network was running at close to 100% capacity during this time. Now, with more normal fulfillment capacity, our operating leverage decreases versus the comparable prior year periods. We'll expect to continue to see some negative year-over-year impact from this in Q1 of 2022. While we navigate these near-term headwinds, the fundamentals of our retail business are strong, and we are optimistic about a number of growth businesses and a strong innovation pipeline. AWS delivered another strong quarter of growth as enterprises and developers continued to look to AWS for critical, innovative cloud solutions. Now to $71 billion annualized revenue run rate, AWS revenue grew 40% year over year in Q4, our fourth consecutive quarter of revenue growth rate acceleration. We hosted our 10th reInvent conference in the quarter, welcoming 26,000 in-person attendees and hundreds of thousands who attended virtually. reInvent remains a highlight of the year for us because it's a great opportunity to introduce new services while engaging with customers and partners to better inform where we should be focusing next. We announced more than 115 new services and features during the event, as businesses spanning all major industries continue to choose AWS as their technology provider to speed up innovation in their organizations. In the past quarter alone, NASDAQ announced a multi-year partnership to migrate its North America markets to AWS, including their matching engine. Best Buy selected AWS as its preferred cloud provider for cloud infrastructure services. Meta,
That's pretty
the
cool.
parent company of Facebook, Instagram, and WhatsApp, selected AWS as its long-term strategic cloud provider to accelerate artificial intelligence research and
That
development.
again.
And Stellantis, the parent company of Chrysler, Dodge, Fiat, Jeep, and Ram, selected AWS as its preferred global cloud provider for vehicle platforms to accelerate new digital products and upskill its global workforce. You can find more examples in our earnings release of how the world's largest companies such as Adidas, Goldman Sachs, Pfizer, Rivian, and more are using AWS to transform their businesses. Overall net income was $14.4 billion in the fourth quarter. While we normally focus our comments on operating income, I'd point out that this net income includes a pre-tax valuation gain of $11.8 billion related to our common stock investment in Rivian Automotive, which completed its initial public offering in November. Before we move to Q&A, there are three additional items.
Yeah, you can see this really huge non-operating income they have here
separating
relative to these
services
years.
revenue from other revenue.
That's
Part of
the
our revenue
Rivian
disclosures by groups and
gains that they
products and
experience.
services. This updated presentation is provided in the supplemental financial information included in our earnings release. We're excited to continue innovating in areas like sponsored ads, streaming video, and measurement. Of course, advertising only works if we make it useful for Amazon customers. And when we create great customer experiences, we deliver better outcomes for brands. Second, we're prospectively updating the useful life of our servers and networking equipment beginning in January. As a practice, we monitor and review the useful lives of our depreciable assets on a regular basis to make sure that our financial statements reflect our best estimate of how long the assets are going to be used in operations. We are increasing the useful life for servers from 4 years to 5 years, and network equipment from 5 years to 6 years. As a result, our first quarter guidance includes an approximate $1 billion of lower depreciation expense.
Now, there's two ways to sort of look at this. You could argue that they're lowering they're extending useful life now to hide a squeeze on margins, or you could argue that they were being too conservative before and sandbagging, and now they're removing that sandbag.
Efficiently on the hardware. This then lowers stress on the hardware and extends the useful life both for the assets that we use to support AWS's external customers as well as those used to support our own internal Amazon businesses. And finally, we will increase the price of Prime in the United States in Q1. We continue to make Prime better. In recent years, we've added more product selection available with fast, free, unlimited shipping, more exclusive deals and discounts, and more high-quality entertainment, including TV, movies, music, and books. Since 2018, Prime Video has tripled the number of Amazon originals. And this September, Prime Video will also release the highly anticipated The Lord of the Rings, The Rings of Power, and become the exclusive home of Thursday Night Football as part of an historic 11-year agreement with the National Football League. Since 2018 in the U.S., availability of same-day delivery has expanded from 48 metropolitan areas to more than 90. Items available for Prime free shipping have increased over 50%.
I do not have any formal education or career background specifically in finance. I'm in school right now. I'm back in school. I mean, I'm going to be turning 30 this year, but I've been back in school working on a bachelor's in accounting. And I hope to move on to a master's in finance. But currently, I don't even have an associate's yet. I'll be getting that literally this semester. I'm mostly self-taught.
Of a Prime membership in the United States, with the monthly price going from $12.99 to $14.
Self-taught meaning I learned from Aswaf the Motor on YouTube to be more specific. But
this is our first price increase since 2018. For new Prime members, the price change will go into effect on February 18th. For current Prime members, the new price will apply after March 25th, on the date of their next renewal. With that, let's move on to Q&A.
Yeah, for the last 5 years, I worked in manufacturing.
Thank you. At this time, we will open up for questions. We ask each caller to please.
I quit last fall to go full-time education.
If you'd like to ask a question, please press star 1 on your keypad. We ask that when you pose your question, you pick up your handsets to provide optimum sound quality. Once again, to initiate a question, please press star then 1 on your touch-tone telephone at this time. Please hold while we poll for questions.
Yeah, I'm sure I could. I'm aware of how unsophisticated some and quite a lot of professionals actually are in finance. Some are really great and really sophisticated and know exactly what they're doing, and other people use really basic stuff. And a lot of it comes down to your ability to schmooze and win clients.
How many of those investments might be behind you versus ahead of you with respect to same-day delivery, and how that sets the company up with respect to either consumption behavior by consumers versus the competitive dynamic you're seeing against elements of like omni-channel and last-mile delivery competitors. Thanks so much.
It's like I've only been trying to learn this for about 3.5 years, which is a long time, but it takes experience, you know.
Ultra fast, which is essentially our grocery business, in 1 to 2 hours, to same day and less, and then 1 day and 2 day prime. We feel good about where we are. We're continuing to build capacity that enables us to hit those cutoffs. I think his comments were.
But I also don't have much money to work with either. So
pre-pandemic levels for 1 day delivery and improving upon that, and then getting same day to more and more metropolitan areas. We're doing that globally as well, but we really think that combination of speed for different product levels or product lines, really resonates with customers. There's a lot of new offers for generally free shipping on a fast basis. But we know how hard this is, and our goal is to do it and do it at a price that we can make money on as well, and have our cost structure commensurate with that. So that's where the difficult work comes in. But we like the progress we've made developing our Amazon logistics capability over the last few years. We've been adding, as we've mentioned,
that's basically the plan. It basically just comes down to getting loans for the education and stuff. But I'm not that concerned on it when it comes down to like my grades and stuff. So
we like where we stand.
Yeah, probably going to go to the CFA.
Improving our customer service. We like the progress we've been making lately, but
unless YouTube takes off and I can just do that full time or something. So that's kind of the thing. It's like I am working towards a degree, but I don't really consider it like something that I like absolutely need.
Right, the first one, there's a lot that's changed within the retail business.
So
pre-pandemic, post-pandemic.
I'll go as far as I feel like I need to go.
More grocery, more last mile investments, and an ad business. Be curious to hear, as you think about the long-term profitability of the retail segment, has your view about how you think about long-term profitability or cash flow of retail fallen at all post-pandemic because of the higher required investments? Is the first one. Then the second one, like the new disclosure, be curious for any other disclosure about the number of engineers or the size of the teams you have working on a lot of the innovation that you talked about, and that are sort of more around early stage non-revenue generating projects, so we can better understand that investment in Amazon. Thanks.
Sure. On the second one, we have a history of making long-term bets for customers, and some of those fall into very small, short-term revenue businesses. They'll generally roll up into other revenue, which you see as very small after we've separated out advertising. So, I think that you do see it in our revenue disclosure generally. But a lot of our profitability is shown at the segment level, and we'll continue to do that with the revenue disclosure. You asked about the business model. I think it's a good question. And we are, as we reflect over the last 2 years, we are encouraged by a lot of things. You checked them off there, the adoption of digital benefits.
Yeah, and like I said, I'm going to be 30 this year, so I'm not exactly trying to rack up unnecessary debt.
Of companies going to the cloud. The ability to double our fulfillment capacity over that time period, including making major strides in our Amazon logistics, sets us up well for the future. But we've been also dealing with a lot of disruption during this time period. So the early wave of disruption was handling volume without the capacity to handle it, and then quickly playing catch up. And as that was starting to improve, labor took a turn in the United States, especially labor availability, and we've really had to scramble to add workers. We've been successful at it. We added over 273,000.
All right, so we'll go ahead and pause them to go over 5-year trend. So taking a look at the sales to capital ratio, as I said, they do still sustain a pretty decently high sales to capital ratio, decent being anything over 1. Retailers typically have pretty high sales to capital ratios, but they usually have trash margins to back it up. Obviously, they had a stronger sales to capital ratio back here, and it's been declining over time. In general, it's pretty impressive that they ever had such sales to capital ratios, even into 2017, because by that point, they were still already having a pretty large focus on the development of their AWS part of their business and being away from a retail core. But obviously, it's going to be a longer transition. I wouldn't be surprised to see it eventually go to under 1 over time, but we'll have to see on that. When it comes to GAAP PE, obviously you can see they're trading pretty damn cheap now relative to the last 5 years, 48 PE relative to 188. On a corrected PE, adjusting for the R&D capitalization, they're currently around 25 for 27 or so. These PEs are not quite accurate on the basis because we still have to do the capitalization for the previous 5 years. But taking a look at their balance sheet, you can see obviously there's been a huge explosion in the shareholders' equity with a huge explosion in the retained earnings. Like I said, I generally consider Amazon to be slightly better levered than some of the ones that are just sitting at like 1 to 3% debt to equity ratios. They could do probably with a decent bit more debt relative to their market cap, but obviously their market cap just goes up at such a fast rate that it can be hard to issue debt to keep the same ratio if that's the deal they're going with, though obviously market caps can come down just as fast. But obviously, as you can see, the assets have not moved up, or assets have moved up at a faster clip than the liabilities on the whole of it, which is part of the reason that the equity has exploded as much as it has, which is on the back of actually having at least a reasonable amount of assets purchased through their debt, which is basically the point I was trying to make in some of the other companies, that if you don't have a significant amount of debt, you're not actually going to get a significant amount of leverage on your returns on invested capital, which again, as I also said in those particular valuations, that if you have a high return on invested capital, then maybe that's unnecessary. In the previous years, you can see the returns to invested capital were really high, up into the 40s even, and now they're starting to come down into the teens, which is much more a reasonable range to sustain for another decade or so. But because of the leverage they have, they're pushing the returns on equity up into the 20s and 30s still. So that's exactly what you want to see. Overall, free cash flow to equity comes out to be $26.3 billion, which is not very much relative to their market cap, but they're not out here doing a bunch of dividends and share buybacks. In fact, they're, if anything, still diluting their shareholder. Their cash flow statements actually didn't have some of that dilution listed in such a way that I could actually list it as a negative number here, but otherwise it probably would be. But if you do look, you can see that there is a consistent amount of dilution going on in the company, though it's a very small amount, and it's backed up by significant growth. So it's simply fine. It's basically just how they pay their shareholders, which is fine. Adjusted net capex has grown pretty significantly over the 5-year period. We've more than doubled overall. You can see that that's especially exploded in the most recent year, which is part of the reason that, like I said, the free cash flow equity is negative, even though they issued debt this year. So that's pretty impressive. They must have high confidence in the investments that they're making for the future. Hopefully they have high confidence in them. And then, like I said, we can only really think of these most recent couple year, or the most recent year, as well as the current number for the net margins as far as the adjusted net margin goes, because we don't have the R&D capitalization for the previous years. But as I was saying, it's not super high relative to the other mega caps that we were talking about, but 12-13% is extraordinarily high relative to retailers in a general sense. So it is a pretty high quality business if you're thinking sales to capital ratio and net margin together on terms of the type of business that they operate. And then obviously their revenues have just been crazily growing each year over year, one way or the other. Like I said, we will look at their earnings stack, but I'm going to do that probably after we get through the full 10 years. So I'll continue the analyst questions.
Employees in the last half of the last year. But I think if you look at the prior year, it was over 400,000. So, you know, there's a lot of expansion that's been going on in the network, and we feel good about the basic contributors of profitability. There's, if you step back, there's, you know, procurement margin and working with vendors and sellers as well. There's, you know, fees in some cases for 3P services and Prime, as we just mentioned, is going up. Advertising has certainly added a layer of contribution over the last few years. But again, that only works and is only successful if we make it a good customer experience. So we're really working hard to do that, and that becomes a part of our ability to offer lower prices, better selection, and more convenience. So if you take those are all you know, stable and strengthening areas. It's really the onus on us is to get our operational efficiency back in all of our areas of cost. We have again built a lot of capacity. We've hired a lot of people. Some of those people are still, our teams are all battling Omicron right now, but we do see the sun coming out and getting better here over the next number of quarters, and you know, that's going to be where we're going to put a lot of our effort.
Yeah, and I mean on the
Our
pandemic.
next question is from Doug Enmuth with JP.
I don't know how close people are paying attention, but the caseloads have been dropping like a rock.
Thanks for taking the question. Brian,
and the deaths never spiked up to the same level that they were at the previous peaks. And even so, they will start to drop like a rock too. Economies around the world are starting to unveil their undo their restrictions.
Yeah, let's talk a little bit.
Looks like
about,
most of the pandemic concerns are coming to an end.
And I'm going to do this with inclusion of.
I suspect we'll have another strong wave this next winter, though it might not even be as high as this last wave, though it could be, but deaths probably won't even be close. And then after that, I suspect it'll be completely over.
How they've grown over the last few years.
In terms of paying attention to it anyway.
Proportions, which I'm not sure we've initially shown before.
It'll just be some low endemic numbers at that point, I think.
CapEx is going into infrastructure, most of it feeding AWS, but also certainly Amazon is a large customer of that as well, as we build infrastructure for ourselves directly or through AWS. About just under 30% is fulfillment capacity, building warehouses, warehouse only, not transportation. And then just under 25% is transportation capacity in building out our AMZN network, principally globally. The remaining 5% or so is small things like offices and stores and other capital areas. But those are the three main areas. If I look to the future, we're still working through some of our plans for 2022, but it's coming into focus a bit. You know, we see the CapEx for infrastructure going up. We still have a very fast-growing business that's growing globally, and we're adding regions and capacity to handle, you know, usage that still exceeds revenue growth in that business. So we feel good about making those investments. On the fulfillment center side, that's about 30% of the spend in the last 2 years. We see that moderating, and that will probably now match growth of our, you know, our underlying businesses. I think there's always things that can tick up that growth rate, things like expansion of our FBA business, expansion of Q.
I don't know if fulfillment costs will be moderating.
Square footage. So, you know, there's we want to have capacity to have a healthy retail and FBA business, because that fuels Prime.
It's like I do see the pandemic starting to relax, but I don't see
that's very important. But we see the FCP,
a lot of the supply issues
likely moderating this year,
relaxing that much.
And then the third piece is transportation. We still see additional levels of investment in that in 2022. So if you wrap that up, you know, we expect
depends
CapEx
on what happens.
Equipment finance leases to increase year over year. I can't give you the exact percentage, but hopefully it gives you a little more dynamic on how we approach it.
Our next question is from Mark Mahaney with Evercore ISI. Please proceed with your question.
Okay, thanks. You'd lay out all of these costs that you were expecting to see in the December quarter. Just talk through whether there were any real surprises to you. So it looked like you had a little bit greater leverage than you may have thought, and then use that to help us think about what the I think you said the sun's coming out. Financially, does that mean that we're going to have a kind of nice improvement in operating margins as we go through the year, as some of those temporary costs, get temporized, and you get to absorb some of the more fixed costs? So just talk about where the surprise was in terms of those costs that you laid out for the December quarter.
Yeah, it's worth noting that their margins would have been much worse if it wasn't for the Rivian gain. So.
Okay, Mark, just remember that I'm sitting in Seattle, so my view of the sun coming out is a little different than perhaps where you are. But no, we do see things improving. We do. Let's step back to Q4. We had said that we would have about $4 billion of additional costs due to labor shortages and the inefficiencies of that cause, as well as increased labor rates and shift differentials, premiums, and external transportation costs. We came in just slightly over that $4 billion. I think things went as expected. I would say that the hiring was strong, but we could have done better. We could have had more people, so we had to cover there was additional overtime. There was some higher costs on third-party transportation. But, all in all, the challenge in Q4 was to staff, increase the staffing. And we said we wanted to add 150,000 people or more. We added net about 140,000 in the quarter, 273,000 in the second half of the year. So as you turn the page into 2022, we feel better about labor, except Omicron has kicked up, and now you have a different type of labor issue where there's a lot of people who are on leave of absences and short term as they work to have a positive test on COVID and can get back into the workforce and protect their fellow workers. So, there's instances where you're paying, twice or three times for the same labor hour. If someone is on leave, you're paying them, and you're also paying potentially for someone who's covering the shift on overtime. So, there's cost pressure in Q1. I think the good news is that the labor the labor challenge is not as great in Q1 as it is in Q4, and Q3 and Q4. So we're hopeful on that. We have to work to.
See, they're claiming that their labor costs are primarily increasing as a result of hour increases, essentially, but not unit labor costs specifically. I do know that on the economy as a whole, unit labor costs have moved up. In fact, hours work have inched back down.
Been working, heads down for over 2 years now. So they need.
If that's true,
we got a great team, and we have confidence that
then
we will.
That puts them at a definite divergence from the general economy as far as that goes. If. Kind of an if.
Our next question is from Colin Sebastian with Baird. Please proceed with your question.
Thanks, and hey, Brian and Dave. Wanted to ask about
right, 3 years left.
Nice acceleration in revenues there. Wondering if you could talk about maybe more specifically the drivers of that acceleration. Is the application layer maybe now large enough where you're seeing that contribute incrementally to growth? And I think in the release you also highlighted infrastructure expansion globally. I think it might be interesting to add some context around the scale or distribution of the AWS
infrastructure expansion in inflated dollars. It's worth noting.
If you could put some context around that, thank you.
Sure, Colin. Thanks for your questions. On the growth rate, I think it's a combination of things. We've been adding resources in sales and marketing over the last few years, and that is starting to pay off. There was some cutback in spending in the early parts of 2020 that we're lapping as people, different companies had different COVID experience. Some, their volumes went through the roof. Some, their volumes went through the floor. So as things have stabilized, I think the lasting thing is that a lot of people made the commitment to go to the cloud, better understood the benefits of that, and probably accelerated their internal timelines for that. And we're there to help, and we're working very hard to make that journey a successful one. And we have a strong team of sales and marketing professionals to help, as well as technical advisors. So, that is what we're seeing, and we're pleased with the acceleration of the business the last 4 quarters.
Big four.
We will see. We're also pleased with the efficiency of the infrastructure investment, as I mentioned. The expansion of useful life is not done on an accounting basis unless you have proof that it's actually, we're seeing it in real life. So very positive indicators in AWS.
Hey, Colin. It's Dave here. Just following up on the the international point. What we're seeing outside of the U.S. I mean, as part of that overall strong growth, we are continuing to see considerable momentum really around the world. It's customers moving their workloads over to AWS at different phases. And so as you look at the release, some of the other announcements, there's a good diverse list of companies. Adidas in Germany migrated its SAP environments to AWS. In the Netherlands, Stellantis selected AWS as its preferred cloud provider. There's a number of really great companies examples that doing different big things at different stages of that migration. What's been important to us, amongst many things, is continuing to expand our global infrastructure footprint, really to support this momentum we're seeing. So just this last quarter, in the fourth quarter, we opened the Asia Pacific region over in Jakarta. And we've got announcements for plans to launch in Canada and the Calgary region next year, or perhaps I think it's 2023 or 2024. So a lot of work and a lot of momentum there. Those are just a few examples. But where we sit now, it's AWS has 84 availability zones in 26 regions around the world right now. And just in terms of the forward-looking roadmap, we have announced to launch 24 more zones and 8 more regions, and those will be here in the next couple of years.
Calgary.
Our next question is from Jason Helfstein with Oppenheimer.
Canada and Calgary.
Your question.
All right, 2 more years ago.
Thanks. So I just want to dig a little bit into
there.
third-party seller services. The growth slowed there even on a 2-year stack. So maybe if you could talk about some of the factors that you think could be weighing on that. And then just on AWS, you kind of laid out some color there. Is there any bottlenecks to growth that you're still seeing? I mean, you talked about why this was a very good quarter and having to do with some of the comps, but any bottlenecks to growth, either supply?
No, I think it is in Canada. I think they were just talking about expanding it. I think it might be new to Calgary specifically.
Yeah, on AWS.
The wording he used was kind of strange.
Yeah, sorry. Let me start with that. No, we don't see bottlenecks on the capacity side, or probably the limiter in that business is our ability to work with customers to accelerate their timelines. So we're investing and working hard to do that. But operationally, we continue to add capacity, as I mentioned on the capital discussion, and we expect that to increase year over year in 2022. On 3P, I think what you're seeing is a decreasing growth rate, much like the rest of the business. As I mentioned earlier, we're dealing with the very high growth period from Q3 of 2020 through Q1 of 2021. But on a 2-year basis, you're still seeing 31% compounded annual growth in the 3P seller services revenue. Granted, that was it was 34% last quarter, but it's maintaining. I think the bigger point is that sellers were definitely big winners in Q4. The percentage of units up to 56% was a record for 3P. Continue to invest a lot to make sellers, help sellers be successful on our site. They're a big consumer of advertising as well, because they use it to build their brands and enable customers to see their selection and make purchases. So we're very very happy with the third-party seller services business, and again, looking for ways to help sellers be successful.
Our next question is from Justin Post with Bank of America. Please proceed with your question.
Great. Maybe we'll talk about advertising services. Maybe tell us why you decided to break it out, if you haven't already, and then how much Prime Day might have been a factor in the deceleration. But bigger picture,
I love that they broke it out.
Does that line have to grow bigger than GMV growth? How do we think about where you are on penetration on that? Thank you.
No, I'm so happy they separated their segment out that way.
We broke it out. We've looked at the proportion.
Because they just happened to break down their segments now into a way that's much more in line with the industrial groups that I have.
For the majority of that line item was.
I think my beta is much more accurate for them now.
Size that we should break it out and then split the other off of that. So that was really the impetus for the change, and we look at those things every year, and end of year was a good time to do it as we start 2022. So hopefully that's helpful for you to understand the growth rate without having to impute it from the other revenue. The growth rate in the quarter, 33%, was down from 66% in Q4 of last year. Q4 last year obviously had Prime Day in it for the first time, and Prime Day carries a lot. I can't scale it for you, but there's a lot of advertising tied to Prime Day, obviously. So when that moves quarters, it generally has an impact on the run rates. We saw that a bit in Q2 of this year when we did have Prime Day.
Almost done.
Q2 2021 was lapping the 2020 period that didn't have a Prime Day in it. So that'll move around a bit, but I think the bigger story here is the success we're having with sellers and vendors and making that a useful product for customers.
And Justin, just to add to that, I mean, it's the priorities with advertising are, at a high level, it's improved the tool usability. We think there's great feedback loops with customers, as Brian mentioned, to keep building and making that better. That results in building more relevancy and better engaging experiences. And again, the more we can interact with the advertisers, the customers, and learn and have more opportunities to hear from them and understand that we can build better analytic tools, provide better measurement, give them better insight into performance. So really focus on serving brands. And it's in the sponsored ad space, but we've talked about video advertising.
Final income statement's done.
A great opportunity, and as we've got properties like Fire TV, IMDb TV, Twitch,
final
live
cash flow
sports, a lot of
statement.
exciting things that have been going on in live sports, and certainly to come this year as well, both in the NFL here in the U.S., but overseas in a number of properties. Really excited to kind of work with folks.
Change net working capital.
Delivering good recommendations to customers and helpful when they're making their purchase decisions and giving them information around that. And that in turn, of course, helps the advertisers as well and have a great result. So I think that's one area that we're excited about. And I think, longer term, demand side platform opportunities with Amazon's DSP is something that we're continuing to work on and refine and again, focus on the customer as we always do.
Our next question is from John Blackledge with Cowen. Please proceed with your question.
Great, thanks.
Yeah, I couldn't remember. I know you told me before.
Could you discuss how I
couldn't remember where you were at.
The business in 4Q and how we should think about perhaps impacts from supply chain issues in 1Q22 and for the year? And then the second question would be, do you expect to increase Prime pricing in non-U.S. markets? Thank you.
Hi, John. Thank you for your questions. First on Prime question, we evaluate each country differently.
Right. So let's get this final
relative price to the customer versus
sheet done.
Our cost to supply that and the usage and the value we're creating for
receivables. Jesus Christ.
We felt, especially after not raising the price in the United States since 2018.
Keeps throwing me off that they list their inventories before the receivables. It's just natural to me to do it the other way around.
Today than it was in 2020, let alone 2018. So other countries will continue to evaluate every year, and nothing else to announce right now. On supply chain, there's specific things that I think we all see in the supply chain where we're waiting for products. But as far as Amazon is concerned, we did a lot to combat the supply chain issues we saw in Q4.
Final equity statement.
We bought a product ahead. We worked with vendors to secure inventory early, so in some cases paid early, which had a working capital impact. We also worked very hard to open up channels of existing channels of put into the country, whether it was port capacity or a vessel capacity.
We'll cut it there, and we'll take a look at all 10 years. Yeah, no, different Big Four. Big Four, I guess, can apply to several different industries. So. So anyway, sales to capital ratio, as I was saying with the 5-year trend, that they had a much higher sales to capital ratio in the past when they were a much more pure play retailer. So as you can see, it's come down as the focus on the more tech side of their business has increased, or just beyond being a website anyway. And you can see the PE ratio in general has come down, as we were saying before. Now we can see a much more solid trend in the adjusted PE. To see that it's actually been trading in some ways sort of flat in terms of where it was starting in 2018. It was a little bit higher in 2017, but there were seeming to be these periods in the 30s and 40s when you're adjusting for R&D, which partially has to do with movements up and down in the spending of their R&D relative to the growth in their earnings, which we'll get into. We'll get into with the earnings statement. So we're just continuing the trend on the balance sheet. It's really just more of the same, that it's been exploding upward. Overall, having a pretty decent amount of leverage, but a pretty well managed amount of leverage, nothing too major, really just kind of staying generally around like 5 to 15% depending on the year, and being less in various periods. Bezos is, obviously he doesn't run the company anymore, but he did run the company for most of this period. Bezos is rather well known for essentially having delevered the business and diluting the shareholder prior to the end of the .com bubble, allowing Amazon.com to be one of the survivors. So he basically has always kind of kept that mentality where too much leverage was too dangerous, and he himself had a finance background, so he understood the importance of at least having a minimal amount of leverage. So that's just one thing to say about Bezos. His successor, also Jeff Lasky, is it? I always kind of like pronounce his name wrong. Also, I'm pretty sure had a finance background as well, so that's kind of interesting to see. A lot of times finance people can be a little bit of a lackluster choice as far as CEO goes when it comes to trying to think about further expansion of your business and development of new technologies. Jeff Bezos was kind of an exception as far as that goes. A good example of this would be Pat Gelsinger versus the previous CEO in Intel, where he was literally an accountant, and they didn't, Bob Swan I think it was, and he didn't really go anywhere for several years, and then now he's been replaced by more of an engineer, and there's a large expectance of a return to growth for them as a result of that. Whether or not that actually plays out is one thing to be seen, but I did think it was an interesting choice for the successor of Bezos. And we'll have to see whether or not he has the same mentality as far as like management and allocation of capital, because Bezos was pretty much an expert at that. So we'll have to see about that. Anyway, moving further along into the cash flow statement, the overall cash flow to equity over the period is only about 34 billion, which is a pretty small amount relative to the entire amount of market cap that they've commanded over the entire time frame. But obviously they're not really out here paying a huge amount of their shareholders. I think I did actually forget to net out the share buybacks for here, but whatever, it's a minor detail. I'm not really that concerned by it. It's not going to affect the actual valuation. I'm not really going to go fix it now. Looking at the correct net income with the overall R&D capitalization over the period, like I said, that only really makes the kind of these last 5 to 6 numbers particularly accurate relative to the other ones. But even so, you can see that the margins were lower in the past, which means if you didn't have the R&D capitalization effect, these would actually even be much lower. proof of that is to go look at the reported GAAP income margin over here. You can see that there was in fact negative margins or extremely non-existent margins for these years, 1% to 2%, much more in line with like typical retailers, starting to push back into more like typical exceptional retailers, and then even now in 5% in 2020 when we had a whole bunch of the stay-home orders and everybody was buying stuff off of Amazon. And then in 2021 we have a 7% margin, but as I said, that's partially on the back of this huge gain from Rivian. If you even just returned this number to the number it was in the previous year, then it drops this margin down to 4.26%. So yeah, Bezos did say F earning. Oh, well, was it Bezos or was it Lasky or was it both? And look, they're like I said, Bezos is king. Bezos is a genius. He pretty much knew exactly what to do. And so I look at this number right here as a promise or delivering on that promise. He basically said, we're not going to be profitable for the next while. He wasn't really talking this type of profitability. He was talking cash flow. And the cash flow to the equity for the shareholder immediately dropped to negative territory. But I mean, $3 billion, the shareholders had to eat a $3 billion cash flow loss relative to 1.6 trillion, so it's like, whatever, no big deal there. So anyway, getting back into the corrected net margin, you can see that it has exploded in this recent time frame. Even if we just ignore 2021 because of the Rivian numbers and look at 1030, like I said, we can return this number to kind of thinking what it was in the previous year to even get an idea of what the corrected net margin would have been. It would have been about 10%, so slightly lower than the previous year, but nothing too crazy as far as that goes. So we'll probably think about 10% to 11% as our baseline for this. So now getting into the actual projections, don't think too much about this number here. Obviously, we have a whole lot to do and we don't really have a whole lot of numbers for growth projected into this at all. We'll start at the bottom, taking a look at the debt to equity ratio. Like I said, here it is, about 7%. I think he could easily double it and it would be pretty healthy. But that's just my perspective. The cost of equity comes up to 10.53% after adjusting for the leverage, which brings the lever beta up to 1.5. Weighted average cost of capital 7.84%. Again, if they increase their leverage, that would bring the weighted average cost of capital down, though it would perhaps bring the cost of equity up a little bit. But the overall trade-off, I think, would be to bring the cost of capital down. Though 7.84% is not a terrible weighted average cost of capital either, especially when you're generating returns on invested capital for the last 3 years on average of 17.62%. So if we think about the debt to equity ratio and current market cap, if the market cap was to say get cut in half, which would be pretty drastic, honestly, maybe like 1/3 more from where it currently is, would be probably a pretty bad scenario as is, but let's just assume cut in half because it might make the numbers a little bit easier. You could assume that they double their debt as well, maybe even bring it up to a solid 300 billion. Then that would still overall leave their debt to equity ratio, what would that be, like 30% really, in like the worst case scenario pretty much. I don't know, we can kind of play with those numbers. Before adjusting for probabilities, that leaves it at 16%. Maybe we'll bring it down to 20 or 25%. And then the analyst number, maybe leave it around 10%. What is that? We'll bring it to 5. So before adjusting for probabilities, we have our debt to equity ratio expectation down to 9.25%. We'll definitely be trying to adjust the probabilities to kind of bring it closer to where it currently is, because I could see them issuing more debt, but I could also see the market cap continuing to move up, depending on where the valuation actually ends up, but other factors involved. Taking a look at the sales to capital ratio, like I said, it has been consistently coming down, and it looks to be likely that it'll continue to move downward. I think we probably do want to project maybe not all the way to 1 as an expected level. That's kind of probably too far, but perhaps down to 1.25 or so for considering the 3-year average is at 1.5 or so. So I don't know, maybe 1.75 as the lower marker, and then maybe like 1.75 as the top. Like that literally will leave it at 1.25. We can kind of adjust some of these things a little bit later. Moving further up to the, well, actually we'll go straight to the revenues, because that's the bigger thing that we need to adjust. The margins, we'll definitely be adjusting the margins, but they're not so far off as the revenues. Now, this is where things get a little bit tricky as far as trying to make projections go. We'll take a look at their earnings deck a little bit, like I was promising. So with 60% of their sales in the North America segment, which, I mean, I don't really like that particular segmenting, but that's a part of how they have it on the deck. But as I said, we looked at it earlier before. I like this way of separating it out. 47% with the online stores, 3 to 4% with the physical stores, 22% with third-party seller services, which includes shipping and logistics, 6-7% for subscription services, which includes Amazon Prime, as well as like Audible and entertainment stuff, advertising services. And this is what I was talking about. I was like, I'm happy that they actually separated this out. That actually makes it really easy to just have the advertising grouping by itself, rather than trying to mix it into one of these other groupings. And then AWS separated as well with a small other category. I actually really like the segmentation, which kind of really breaks it down into the actual types of businesses that they have. The online stores is going to grow probably a similar rate that it already is, which we will take a look at the earnings deck for that. Physical stores, we can assume, are going to grow at a pretty slow typical retail rate of 1.2%, but they're likely to be pretty stable. These third-party seller services and subscription services are likely to grow in tandem with the online stores to a certain degree. Advertising services will move in line with the economic activity, as well as it's worth noting that the third-party seller services will also move in tandem with economic activity. So if the economy takes a dive, those will have bigger hits. And then AWS, I do think it's likely just to keep growing in the background, kind of no matter what, as the bigger growth engine. And like I said, this earning deck only splits it into the 3 categories rather than the like 6 or 7 that we just kind of narrowed it down on. But still paying attention to how they group it, you can see, as they were talking about, 9% year over year for the North America group, which includes basically most of the non-AWS stuff, is international, which is basically the same thing but just internationally segmented. So that's what I hate this grouping. It's like the North America international AWS is kind of a useless way to separate it, if you ask me. But either way, the AWS 40%. If we kind of assume the AWS is going to likely continue to grow at 20 to 30% COGR or something like that, pretty strong, and they have 13% of the revenues, and so we assume that the rest of it is going to grow maybe in the upper single digit level. Then I can see Amazon in general kind of approaching a teens level COGR to possibly even mid-teens. I'd be hesitant to kind of push too far up into upper teens. Obviously they currently are rolling at 28%, and the push is to maybe push it into 20s. And I am going to put a really high number as far as the cap goes, probably 25 or 30%. The real question is where I want to put the bottom and the overall distribution for the probabilities. Let me actually try to wait this out. If we just try to fix this calculator setup. Okay, we assume the 9% that they grew for the other segments of their business grow at 75% that rate for the next period of time, and then have it at its weighting. And then we add that to the weighting of AWS, also growing at 75% of its current rate, which is 40%. Then you end up with 17%. So I think I will try to make my median point 17%, and then I'm probably going to weight the probabilities closer to 20. That's basically kind of how I'm going to do this. A little bit of a weird, arbitrary setup of it, but I'm essentially assuming that they are going to grow at basically 75% of each category's current growth rate. A little, like I said, arbitrary, but I like to assume that things are going to slow down, maybe not too much. As far as how we're going to tilt the probabilities now, this is where I'm going to have to shift the other the other categories back a little bit. Typically kind of bring the probabilities forward a little bit. That brings the expected revenue CAGR to 19%. All right, so now let's deal with the margin. We do need to actually, wait, I want to leave the cap there, but actually, yeah, we might not really change the margins on that, but I don't know. I might give them a little bit more revenues, push it solidly into 20. Hold on, I had to have done my math wrong on that. Now that I'm thinking about it, that doesn't actually make sense. All right, expected debt to equity ratio is at 8.25%. So maybe we'll give them a little bit more benefit of the doubt on the sales to capital ratio. Have it come down, but not as solidly. I was kind of trailing it off of the most recent year, but we'll try to make it more completely a downward trail from the 3-year average, on the assumption that this 1 year is a little bit more of an outlier. So now you can look at this as like, as soon as the valuation starts to look not as great for a company, I start shifting into giving them benefit of the doubt territory. I was thinking more conservatively on the revenue projections, and then I was like, well, yeah, let's maybe give them a little bit more. Then I see that valuation still south. I'm like, well, maybe their sales to capital ratio will do better. I am concerned about trying to give them too high of a net margin, though. It's like I said, if we take out the Rivian gains, this is really a 9 point something, 9.3 or something like that, 9.7. Which, you know, they've kind of been growing it consistently over time, but they can only really grow it so much. These are R&D, again, capitalized gains. So if they're going to keep having such growth in R&D, which they necessarily have for the growth of the revenues, it becomes hard to suggest that they're really going to push the revenues that much higher. So I don't know. I feel like I can't really necessarily adjust the revenues. So I can just kind of give them more, or not the margins, but the revenues. It's pretty much the only category I feel like I guess I can give them more benefit of the doubt. But even so, then I start to feel real hesitant about it. Not really helping too much more. Trying to figure out what I must have done differently in my previous valuation. Like I said, I try not to look at previous valuations and to kind of poison my perspective, but I am surprised at the huge discrepancy. I don't know about that. Servers and chips are very capital intensive. Doing AWS is not the type of business that is likely to have a low sales to capital or to have a high sales to capital ratio. The retail business was the big business that was likely to have the higher sales to capital ratio. But I mean, even so, I mean, that gave them a little bit of a boost, but not terribly much. Like that right there is about the most I could possibly give them, I think. Because that would be suggesting that they're going to go back to a higher level than they were in 2019 or 2020, back to closer to where they were in 2018. Like I said, because you can look, it's like as they've shifted from retail towards other things, it has come down. So it's like, I don't know. The like I said, like the thing that I can argue, the thing that you can easily argue that they'll get more of is revenues. That's the thing that will save their valuation too, but they need a lot of it. That's just the truth. Or higher margins. But like, let's play with this. I mean, yeah, see, by giving them a 20% top level margin, which gives them an expected margin of 13%, which was the margin that they would have if the Rivian gain was part of their actual operating business, as well as an expected revenue growth of 41% for the next 5 years, and then you have a highly balanced thing. Let's try to make the valuation closer to equal. Okay, yeah, that's better. It's like we're gonna retroactively try to play with this. Okay, yeah, so look, okay, that's pretty good. 35% COGR with an expected R&D adjusted profit margin of 12 to 13% on an expected basis, with a sales to capital ratio of 1.46. Oh, I guess we could do that. And then that's how you get Amazon to fair value. See? So it's like you can play with the model to figure out like what makes the company fair value, but it's like that's a lot of benefit of the doubt I have to give them. Okay, so like 27.63, that puts it in line with kind of the more recent years of growth. Back down to that. 35, and let's put this at 25, 26. All right, well, we'll give them more here. How about that? All right. All right. That's probably where I'm going to leave it, I guess. Let's see. Anything else I'm missing that's screwing it up? Tax rate. Yeah, we do need to adjust that. That should give them a little bit of a boost. We'll bring the terminal tax rate up to 12%. Yeah, see, it's like, and I mean, you can maybe even see why the market would price certain things like that in, because look at the earnings deck. The AWS got 40%, right? So you know, people can, and it's not even like necessarily people are thinking that. People are probably in their own models just thinking like, oh, well, if AWS manages to get a 30% CAGR for the next 5 years, what if AWS becomes like a third of their business or even half of their business? You know, you can see how some people will tell themselves these stories. And then if it pushes beyond that price, like maybe that gets them to a price of 2,700 or something. Well, then maybe 3,000 doesn't look too terrible, right? So, you know, and then you're just like, well, it's just a little overvalued or something. It's like, you know, you can see how prices get pushed up. And obviously people don't necessarily use DCFs. They also use multiples and stuff. So if you're just looking at the average PE of Amazon for the last 5 years or something, then right now it just looks extraordinarily cheap, no matter what. So I mean, it probably will be, but how many years is it going to take to get there? And at what CAGR is it really going to grow as it approaches that? You know, that's the question. It's like, what was it? It's 13% of their business right now. Yeah, 13% of their business right now. It grew at 40%, but the other chunks are growing at around 10%. So if the other chunks, like I said, if they continue to grow around 10% and AWS continues to grow around 40%, I can't really do that math in my head right now, but I feel like it would take closer to 10 years to get to half. And that's assuming the 40% growth rate stays, which I don't know, maybe for AWS it's possible. So okay, so let's wrap this up. Enough kind of thinking abstractly about how valuation works and stuff, which is fun. But so AMZN, Amazon, definitely didn't get as nice of a valuation today as I was kind of hoping or expecting to do. Things are always interesting. Like I said, I must have had some rosy glasses on when I was making projections, probably on their margins or something. If I had to guess, I was probably giving them some rosy margins. But I don't know. It is what it is. I'm very optimistic on the business, but stock is what it is. U.S. Treasury each day selling for 1.918%. Or wait a minute, that's not right. I feel like the calculation, I have it set up to bring in a backup interest rate if the function's not working. So I'm going to assume that means it's not working. Oh, well, maybe it did drop, actually. Interesting. Okay. Well, the Treasury's down to 1.96 today, so I guess maybe that's not as far off as I thought, but it is still off. Okay. So US Treasury selling for 1.96% today. Mature market equity risk premium I have is 4.81%, which gets me to a discount rate for Amazon of 10.5%. They don't have any dividend today. 5 years ago, the sales was $135.9 billion, and the most recent year is $469.8 billion, which is 28% sales growth for the last 5 years on average. Yeah, so you know, it really just comes down to an argument of how much you think that's repeatable, basically. And sales capital ratio in the most recent 3 years on average is 1.54, and the returns on invested capital for the last 3 years on average is 17.62%. Debt to equity ratio is 7.07%, and default risk, oh, I totally forgot to do the default risk. I guess we'll have to stop momentarily to do that. It is pretty crazy, especially considering it went from 136 to almost 500 billion in 5 years. It's like, and again, like I said, it's like I think it can do close to the same thing again. I just don't think it can do past that, really. You know, it's crazy because like everyone thinks of Amazon as like one of the biggest companies in the world, but in terms of sales, they're really not. Which is like one of the arguments that Bezos made in front of Congress. When he was driving for them, he was like compare us to like Costco or Walmart or you know, like stuff like that. It's like, well, I mean, we don't really have that big of a market share in terms of that, and it's like, well, you sort of have a point. 500 billion dollars is a huge amount of sales, but they still have a huge amount of room to grow despite that. as weird as it is. So well, there's pretty much no no major default risks here. These ratios are all really high. Interesting. Super low interest rates they've got. That's pretty much non-existent default risk. All right. Anyway, as I was saying, default risk in the most recent year is pretty negligible, less than 1%. R&D adjusted profit margins for the last 3 years on average have been 11.23%. These compared to the industrial groupings of 9.72%, so they do have higher margins in their industrial grouping, but they do have lower sales capital ratio, which, like we said, is partially because they're just not a pure play retailer, and that's mostly what they comp with. They have profit in the most recent year after adjusting for those capitalized R&D of $60.1 billion, and they're selling for $3,065.87. Our probability distribution is pretty heavily tilted towards the optimistic end of our projections. We have revenue projections of anywhere from $944.9 billion to $2.1 trillion in the best case scenario, giving us a $1.5 trillion expected sales in the 5-year forward period. Yeah, that's crazy to think about. that's pretty crazy to think about. So one thing, it's like, yeah, this is the sales they actually have. This is the sales I'm putting into a DCF right now. It's like, wow, that's crazy. Sales and capital ratio, our projection is 1.46, so we do assume that it's going to come down a little bit, partially on the back of increased investments into AWS. Returns on invested capital, however, we do project are going to grow pretty significantly to 26%, which is really growing back to 26%, which is closer to where they were like 5 years ago. Our debt to equity ratio, we have a range of 20% to 0%. On an expected basis, we have around 9%. And default risk for that is less than 0, around 0.45% per year for the next 5 years. Profit margins, we have a distribution of anywhere from 5% to 20%. On an expected basis, we get 13.63%, which gets us profit expectations of anywhere from $47.2 billion to $421.3 billion in the best case, which gets us an expectation of $213.6 billion. So, like, think about that. The profit projection I have for this DCF is almost half of their current sales. For the 5-year forward period. That's pretty crazy. Think about too. Based off of the discount rate that we have of 10.5%, we come up to a present value of $25.43.48, which is 17% over the current share price. And we have 5-year forward value targets of anywhere from a little over $1,000 to just under $9,000, unadjusted for dividends that they pay out or any stock splits or whatever have you that could happen during the period. We do have an expected value of $4,189.68, which compared to the current share price gets us an implied return of 6.45% each year for the next 5 years. The short-term pricing metrics based off of multiple regression and fundamental input compared to the S&P 500 gets us an implied suggested price of $37.54, which would be 22% over the current share price. So as you can see, based off of the growth and margin expectations that they have, as well as the current multiples they have, which is basically the stuff that kind of goes into this, yeah, you would expect them to trade a little bit higher than they currently are. But based off of the cash flow that they're going to generate, the risk is just not properly accounted for. Unfortunately, that does get them a value score based off of our personal metric of 0.59, which is not very satisfactory. Like I said, I definitely expected better here. Facebook performed in the valuation about as well as I expected it to, but the Amazon one did not. That is the way that is. You know, happens to be. I am going to kind of pull open this summary from the previous valuation to kind of take a look and compare some of these things that I'm putting in to see. Yeah, interesting. Okay. So let's take a look. I'll bring it up over here so we can see the differences. I'm projecting higher sales growth now. I'm projecting a higher debt to equity ratio now, which does help them, by the way. And I'm projecting a higher margin now. But regardless of that, my valuation comes to a lower point. Now, it is a much lower sales to capital ratio. You can see that that is a huge part of it. I'm not 100% sure what I was doing here. I think that some of the functions in this spreadsheet must have been different or something, because some of these things look like a little bit shifted. One other major change you can notice is the difference in the discount rate. So there's a huge shift in the way I must have calculated the beta, as well as a shift in the debt to equity ratio calculations, as well as a shift in the equity risk premiums, as well as a shift in the interest rate setup. So yeah, I'm actually technically being more optimistic on the fundamentals with them this year than I was last year, in pretty much every category except for the sales to capital ratio, which, like I said, has an effect, but I don't think it has that huge of an effect. Technically, the margin has a larger effect, I think. And like I said, I technically projected them a slightly larger margin. So, interesting. DCFs can do strange things when the discount rates change so dramatically, as well as a few other details change. So that is going to be it for Amazon. As I said, we were going to talk about a couple other little things here before I sign off, which is really just kind of economic data and stuff. So yesterday the consumer price index reported its numbers, as well as the consumer sentiment numbers reported today, and I definitely wanted to talk about those a little bit, as well as kind of my thoughts on inflation and the Federal Reserve's upcoming emergency meeting that they announced. I'm not sure anybody's necessarily seen it, but the Federal Reserve did announce an emergency meeting on the 14th, Valentine's Day, which is pretty interesting to see, especially considering they just got out of a meeting only like a week and a half ago or so. And it's right after the new CPI numbers came out today, which for anybody who didn't hear, was higher than expected. The current year-over-year number is 7.5%. So we're going to talk about some economic data a little bit here. Firstly, I was going to talk about the consumer sentiment numbers as they did come in today, which we're going to talk about just the smallest amount. Just want to point out that they aren't super great right now. The consumer sentiment number is a normalized number, so basically as the index moves forward, they readjust all of the past numbers to make sure that the overall spiked average is around 100. So anything below 100 is considered below average. Right now, consumer sentiment is not doing so great. 50 basis point hike, you think? We'll see. We'll see what they do. I don't know. It could be 0 hikes. It could be 1 whole percentage point, in my opinion. We'll find out. But we're gonna talk about that. So yeah, obviously, consumer price index really high. Back up to the levels it was when we were just beginning the path of fighting inflation. We're dealing with inflation all through the 70s. For anybody who doesn't really know the full history of how that works, it all began really with Vietnam. That's the thing a lot of people don't talk about, is that we racked up huge government deficits in Vietnam. And then after Vietnam, we immediately started the war on poverty, which expanded Medicare and Medicaid, which also expanded the government deficits. So we basically went through two decades of massive government spending for different reasons, which racked up huge government debts and eventually made our trade deficit get really bad, and people started pulling gold out of the system when we were still on the gold standard, until eventually we went off the gold standard here in 1971, the end of it. And then after that, inflation started to go crazy after the oil embargo happened simultaneously. Now, people often blame different things, different aspects of this. Some people blame all of inflation on the oil embargo. Some people blame it all on going off the gold standard. Some people blame it all on the government deficits. And really, it's a huge combination of all these things. Inflation, after we went off the gold standard, inflation was going really hard. Richard Nixon also put us on price controls, which made the problem even worse for a long period of time, until eventually we reached the 80s and there was large political backlash, which led to the election of Ronald Reagan, who was much more conservative than the previous set of presidents, as well as Richard Nixon was also a Republican, but he was kind of leaning the other direction as far as economic policies go. So it was a little bit of an interesting path. But Ronald Reagan kind of turned the other direction. He had lots of negative aspects too, but some of the good things he did was put Paul Volcker into the Federal Reserve, and then they started to fight inflation. And as a result, inflation started to come down pretty dramatically until the 90s when it was a pretty low, moderate level until it spiked up again in the mid 2000s before really disappearing for the aughts and stuff until recently. Now, obviously, there's many different ways to measure inflation. I have different indexes I like to pay attention to here. The Consumer Price Index, which is the one that we mainly talk about. The Personal Consumption Expenditures Index minus food and energy, which is the Federal Reserve's favorite index to use. The one they primarily think about. The Gross Domestic Product and Price Deflator, which is basically a measure of how they calculate backwards in time using GDP to come up with a real growth product number, as well as the Producer Price Index, which gives you an idea of what businesses are paying as input prices for all their products. And I'd like to look at all these measures, and you can see that they do kind of move in tandem, though different ones have higher levels of volatility relative to others. There is also the Federal Reserve's measure of projected inflation, which involves a variety of market-based factors as well as economic data to come up with kind of their own in-house concocted way of projecting inflation on 1 year, 5 year, 10-year bases. And you can see that their projected inflation is extraordinarily low, which is very, very strange, considering obviously we are experiencing such high inflation. They seem to believe that inflation is just going to go away, and that's that they're not really gonna have to fight, or at least that's always been the argument pretty much up until this week and when they announced this emergency meeting. Now there's also market-based measures of inflation, which has to do with bond rates and different calculations between them. These bond rates have started to move up a little bit, but they also are not really pricing in a proper amount of inflation. Now, why this matters, the market-based measures of inflation not properly pricing it in, is that means that certain other things that are priced based off of these market measures, like for example price adjustments for different types of commodities, of what people expect the commodity price movements to be, have to do with the market-based measures of inflation. So when people expect certain commodities to move up in the future because of unexpected inflation, they typically look at these measures assuming that they're going to be relatively right. So if there's a huge spike of unexpected inflation, as we've had in the most recent few years, that hasn't been priced in according to the market, then that means you're going to have larger spikes in commodities moving forward. The reason why I'm talking about this, like I said, is that we're talking about inflation also so that I can talk about my thoughts on gold. Now, like I said, that market-based measure of inflation basically takes the TIPS rate, which is the inflation adjusted bond yield, and subtracts it away from the regular bond yield in order to find out what the expected inflation rate is. Now, if you actually take the bond yield itself and subtract out what the real inflation was, not what its expected number is, then you end up then you end up with this blue line that we have on this chart. It's also inverted, so you can see that whenever the blue line is below the black bar, that means that the real yield on the US Treasury is higher than the inflation rate, which in general, that's exactly what you want when you're going to be fighting inflation. In the 80s, you can see that it was significantly higher than the inflation rate until the 2000s, when it started going below the inflation rate. We didn't have a huge amount of inflation during the 2000s, partially because there was still a huge amount of trust in the US dollar, but that trust has started to break down. And as that trust started to break down, you can see that the blue bar is also starting to spike up even further. Incidentally, the red line on this is corporate profits as a percent of GDP, which you can see that there's a direct inverse relationship between these things. The reason why I bring that up is because, like I said, the last time we had a huge bout of inflation, people called for price controls as a result of the belief that the inflation was showing up as increased profits for corporations, which we do have a lot of that going on right now. So as people start to see the inflation roll through the system, they're going to start to blame corporations, and they're going to start to push politicians to put on price controls. Hopefully we don't end up with price controls. Hopefully we learn our lesson from the last time, because that basically just extends the inflation problem and makes it go on longer. But unfortunately, I'm already starting to see those cries on places like social media. So now this same chart, like I said, with the market yield minus inflation inverted, that shows it right here, which is it was the blue line from the last chart, but now it's been flipped upside down. It's been inverted. I don't actually have a year-over-year gold chart to look at this, but if you actually look at the year-over-year change in gold, you can see that there's a strong correlation between these lines typically up until basically around 2000 or so. The year-over-year change in gold would be roughly in line with this, though the magnitude would be at a different level. That has to do with basically, like I said, people's expectations that as long as the interest rates are strong enough, then the drain on the dollar in which the interest rate is based, then people don't feel the need to flood away from the dollar into a safety asset such as gold. But when it does move over that level, that basically means that the inflation is hotter than the inflation is hotter than the currency's ability to fight it. And right now, that we are at an extreme level of that. And I bring that up because, unfortunately, gold has not reacted in quite the same way of that, but I do think that provides an opportunity for people that want to pay attention to that. I don't necessarily think that gold is exactly a great bargain right now, but if you do have a negative view on inflation and you do believe that inflation is going to be sustained, then depending on what you think is going to happen as a result of it, the gold can be a decent opportunity for you. It's not a valuation asset. There's no cash flows based on this. This is about the closest you'll ever see me talking about like technical analysis is when I'm talking about commodities and the pricing of it. But the problem with the idea that the interest rates are going to move up to fight inflation is that basically puts a limit on the government's ability to expand their own deficits due to interest costs. What do I think is going to happen with inflation or interest rates? Which one? Or both, I guess. I mean, I'm sort of working on the whole idea here. As far as like this next meeting goes, I do think that it's pretty likely they will increase interest rates, but I don't know that how much of a percentage it's going to be, and I'm not sure how much of it's going to matter. Typically speaking, when interest rates rise, gold typically falls because people see the interest as a viable alternative to gold where you don't earn any interest whatsoever. And however, that principle is entirely based on the idea that the interest you're earning is a real return, real meaning adjusted for inflation, which is why I have this chart of, like I said, the interest rate subtracting out inflation, but not the market expected inflation, actual inflation. So this chart shows you the year over year real return on the US Treasury. And whenever it's flipped upside down though. So like I said, it's the inverse of that. So whenever it's in negative territory, US Treasuries are positively yielding. And whenever it's in the charts in positive territory, they're negative yielding. And whenever they're negatively yielding, then that means you have to crank up your interest rate over this level in order to fight inflation. So even if the Federal Reserve raises the interest rate by 0.5%, that's only going to bring that might bring the US Treasury up to 2.5% or something. It's around 2% right now. That's not going to fight off 7.5% inflation. Because the negative yield right now is 5.76%. So in my opinion, inflation has to either come down or interest rates have to rise, some combination of 5.63% in order for the inflation to actually get under control. That would require interest rates, however, to rise to or not interest rates. That would require interest payments as a percentage of government spending to rise to like over 25%, and that would put a huge limit on what they can spend. So I don't personally think interest rates actually are going to rise enough to fight inflation. That's basically the point I'm trying to say. I think over the next year we might see interest rates rise up 1%, maybe. I doubt it. I personally don't think 7 hikes will happen this year. I could see 3 or 4 hikes, but I could see all of those hikes maybe being in chunks of 0.5%. But even if that happens, I think there's a good chance we go into recession as a result of it, and that they then bring the interest rates back down. That's the problem. The problem is that if they raise interest rates, the people end up straining too much, and then the economy crashes, and then they pump out money again, and then when they pump out money again, that it brings more inflation. Here is the growth of the M2 money supply year over year, as well as the growth of what is called the Austrian money supply. So it's a slightly more corrected measure of the money supply. And you can see the red line is the M2. M2 typically moves up and down as it is, and you'll notice that the blue line moves over the red line and under it at various points. Whenever the blue money supply, which I consider to be the basically good money, it's money that's generated by growth in business, while the red money supply is money that's generated by government spending in excess of each other, because it's really a combination of both. But whenever the blue money supply dips below the red money supply, we end up going towards a recession. It's not perfect. It doesn't happen every single time, but it happens almost every single time. And then as we come out of the recession, the blue line accelerates up over the red and goes much higher. You see it over time. Now here's the most recent recession, and you can see that we did accelerate back over the red line, and then we dropped back below it rather significantly, and we are still below it. So this is a pretty big recession indicator as far as I'm concerned. As long as this blue line stays below the red line, I think we're at risk of recession. And you can back that up against the 10-year interest rate minus the 2-year interest rate, which is a pretty common recession indicator that people like to look at, which also typically moves down towards 0 as we go towards a recession, and then moves back up as we come out of it. Right now, that number is at 0.42. So we're at high inflation and very, very, very possibly about to go into recession anyway, even though we still have large amounts of supply constraints, which means the inflation will likely keep going even though the recession is happening, which basically looks exactly like the stagflation period of the 70s. And that leads me back to gold, which is to say that whenever interest is negative yielding, gold tends to massively outperform. As you can see here on this chart, the last most periods where they had massive performance of negative yielding was in the 70s and the early 70s, or the mid 70s and the late 70s. If you look at the gold chart, you can see that the mid 70s and the late 70s were huge spikes in gold. We did have spikes in gold in the mid 2000s, which was another period in which we did have some of that activity, but obviously it quickly reversed. So that's part of the reason that we then floundered as a result after that. And I would argue that we're preparing ourselves for basically another scenario. So this isn't exactly a sales pitch for people to go out and buy gold. I already own some gold, but it is a warning sign for the US dollar in general and US markets. I can see interest rates moving up, but I don't think interest rates can move up fast enough to fight inflation without massive cuts to government spending. I think the government will try to fight inflation with interest rates this year. Like I said, I think they'll do maybe 4 or 5 quarter point increases, or maybe 2 or 3 half point increases, and then they'll stop as the recession starts, and then they'll quickly reverse course and go back down again. They'll basically give up and decide that they would rather print more money instead, is what I think is likely to happen. Because that's technically one answer too, is to just print more money and hope that eventually things cool down anyway. I don't think it's a very good solution. My preferred solution is to cut government spending, but either way, that is what I think is going to happen. So, random kind of rant about inflation and interest rates and the possible coming recession over. There's also the military concerns. I don't know if anybody heard the Defense Department's statements today about their belief that the Russian military may be preparing to invade Ukraine within the next week. Obviously, there's been a lot of talk about that for the last couple of weeks or whatever, but there was refreshed concerns about it today, specifically surrounding apparently the Olympics week, which we'll see how that goes. That looks like a great way to keep the supply chain problems rolling. So that's just more concerns to have. And that also prepares another situation where they would perhaps increase government spending, because wars typically increase government spending beyond the budget. So that's just another reason that it makes it harder for them to increase interest rates. And of course, you can always argue that the Federal Reserve is supposed to be independent, so they should be able to increase interest rates regardless of what the government's doing. But the truth is that, I mean, they're not really that independent. So, you know, I mean, they're still put there by people and can still be replaced by people. So I don't know if we end up having some more conflicts or more disasters to deal with, well, then the government's probably just going to spend money the way they're going to spend money. The purchasing power of the dollar be damned in the short run. And yeah, stocks may suffer, but they, in the long run, probably still will be the best performing asset. Even though, like I said, I was still sort of making a bit of a sales pitch for gold. Gold is the best asset in very particular times, and then the worst asset in other times. I'm just arguing that we could be perhaps in a position for that to be one of the best times. So that's going to do it for us today. Like I said, we will be having another stream tomorrow. I think we're probably going to be covering Tesla, or I think, like I said, I'm pretty certain we're going to be covering Tesla. We'll be doing it around the same time, usually around 2 p.m. My time, which is Mountain Time, I believe, Mountain Standard Time, Arizona time. So I will catch you all next time.